You are a conscious person, and you wouldn't like to risk your hard-earned money. The stock market has been on a ride lately. The global economy remains unstable, and crypto is just too risky at your level. And to add insult to injury, you're feeling overwhelmed with so much influence clutter that you'd rather look for a safer investment. Hello dear viewer, and welcome to Markets. This is Eric, and in this video I'll help you navigate bonds, the bond market, and why this unsexy and often neglected asset is one of the keys to building your wealth. Bonds are a type of interest-bearing contract in which an entity lends money to another entity in need of funding. As with most other contracts, they include many pages of legal clauses specifying the promises made. In the case of bonds, it is called the indenture. But in simple terms, bonds can be seen as a formal payment promise or IOU note. That is because borrowers promise to pay back investors on a specific date the face value or principal value of such a bond. Before you start scratching your head, the principal value of the bond is nothing more than its dollar value at maturity. And the specific date, also known as term to maturity, can extend anywhere from just 1 day to 30 years, and in some rare cases can be as long as 100 years or even more. Moreover, only their mother and their dog would lend them money without expecting something in return. So, for most bonds, especially those beyond the year mark, the issuer is obliged to make certain payments, aka coupons, as a way to pay interest along with the principal value of the bond. The only exception would be the famous zero coupon bonds, as they are issued at a discount on their face value. But more on that later. Once the principal has been repaid, the issuer of such bond no longer has any further obligations from the debt. That being said, it should be no surprise that bonds are a type of debt instrument within the financial market. Compared to other loans, bonds are primarily securities because they can be bought and sold on the open market. The bond market, that is. In that sense, the entity issuing the bonds will obtain its funding by issuing new bonds on the primary market. At this stage, the sale is usually handled by one or a group of dealers and/or brokers. They in turn earn a commission by selling such bonds to investors. After the initial sale, the bonds will eventually be traded on the secondary market between investors, either through stock exchanges for listed bonds or more likely over the counter. As a brief reminder, over-the-counter trading or OTC trading is a kind of trading that takes place between two parties directly, say dealer to dealer or dealer to investor, in contrast to exchange trading, which is done on a highly regulated and structured public market. In fact, most bonds trade multiple times before their maturity. Secondary markets are commonly very liquid, since the investors that provide money to the borrowing entity by purchasing its bonds can exit their position by selling such bonds to other investors, without worrying about selling them at a much lower price or incurring big transaction expenses. In other words, they are easy to turn into cash. That being said, in the case of corporate bonds, they tend to have pretty poor liquidity. Most primary market investors just buy and hold them until maturity, which results in very few secondary market trades. And as some of you might expect, the size of the market and the trading volumes vary depending on the type of bond. It is easier to talk about commonalities between bond types than their many differences, since, unlike stocks, certain bonds can have widely different characteristics from one another. The three main features that differentiate bonds are the length of time until the bond matures, the type of interest they pay, and their overall creditworthiness. In terms of maturity, 1 to 5 years are considered short term, 5 to 12 years are considered intermediate, and maturity durations greater than 12 years are deemed long-term. Moreover, there is a somewhat general rule that maturities less than 12 months are considered money market instruments. When dealing with the type of interest, they are generally divided into whether they pay a fixed or floating rate. In the same logic, they are separated whether they pay intermediate coupons or none. And finally, the frequency in which interest is paid. As another rule of thumb, most coupon bonds pay either annually or semi-annually. Now, when we're talking about creditworthiness, it's not the same to give out your money to that sketchy influencer promoting his latest NFT to lend money to the government. In the worst case scenario, the latter can do what it knows best and keep printing money until the economy collapses, whereas with the former, well, you end up publicly exposed for being a greedy you-know-what. Oh yeah, I'm broke. But in all seriousness, government bonds are among the safest investments because they are backed by the full faith and credit of the issuing government. Treasury bonds in particular are considered very low risk since they are backed by the US government. Corporate bonds in turn are issued by companies, and so they tend to be riskier but also offer higher interest rates. Government agency securities are issued by various government-sponsored enterprises, also known as GSEs, and federally related institutions, guaranteed as to principal and interest by the full faith and credit of the US government. Here, the most common types of GSE securities are mortgage-backed securities, aka MBSs, and student loan securities. MBSs are created when a GSE purchases mortgages from lenders, bundles them together, and sells them as securities. MBSs are traded in the secondary market with prices that reflect changes in interest rates and the underlying mortgage's prepayment speeds. Although MBS investors do not have direct ownership of the underlying mortgages, they benefit from payments made on the loans. Student loan securities are similar to MBSs, but are backed by student loans rather than mortgages. And finally, municipal bonds are issued by local governments to fund projects like building schools, hospitals, and highways. This list of bonds and their features may look daunting at first, but for now, you just need to become aware of them. You also have to bear in mind that the higher the return on bonds, the higher the risk that something plays against you. So, if you're saving for retirement or a big purchase, government bonds and CDs, and by CDs I mean certificates of deposit, are the safest options. Otherwise, if you want to maximize the growth of your portfolio and you can afford the extra risk, you can add up bonds with higher yields across different entities and with more complex payment structures. In addition, when deciding to invest in bonds, you should also be aware of details such as taxation, cash flows, any embedded options and refunding provisions, and even collateralization. But let's stick to basics and first learn about bond prices. As I previously said, bond prices are determined by several factors, especially the issuer's creditworthiness, the length of time until maturity, and the coupon rate. The first factor is the creditworthiness of the issuer. This is because bonds are essentially loans, and like any loan, there is a risk that the borrower will default on the debt. The higher the credit rating of the issuer, the lower the risk of default, and the higher the price of the bond. The second factor is maturity. Bonds with longer maturities generally have higher prices than bonds with shorter maturities. This is because there is more time for something to go wrong with a longer-term bond than with a shorter-term one. The third factor is the coupon rate. The coupon rate is the interest rate that bondholders receive from holding the bond, and it serves as a premium to an investor for delaying the payment of his principal. Bond prices, like any other financial asset, are simply the expected present value of their future cash flows. And these three factors that we just covered give us just what we need. Hence, you can get the price of a bond by using this very intuitive formula. We have that the bond price equals its first cash flow divided by 1 plus the rate at time 1 raised to the power of 1 plus the second cash flow divided by 1 plus the rate at time 2 raised to the power of 2, and we do this all the way to the final cash flow plus the principal divided by 1 plus the rate at maturity raised to the time at maturity. Here we can see that the cash flows are given by the coupon rate and they are a percentage of the principal. The rates must be the ones appropriate for that period, and the time reflects the entire life of the bond and the frequency of the coupon payments. As an example, let's say that you want to buy a 2-year bond with a face value of $1,000 and the coupon rate of 10% annually. You also know that the appropriate rates for that bond in the first and second year are 3% and 3.5% respectively. You find that the bond price is equal to 100 divided by 1 plus 3% raised to the power of 1 plus 100 plus 1000 divided by 1 plus 3.5% raised to the power of 2. That's equal to $1,123.95. This price makes sense since the coupon rate is quite high in comparison to the interest rates that apply for the first and second year. What happens if instead you receive the coupon semi-annually? That means that you will have 4 cash flows of $50 instead of 2 of 100, plus your principal at the end of year 2, since each year has 2 periods of 6 months. In the same way, you will have to adapt the annual rates as if they were semi-annual and divide them by 2. And what if the bond had 0 coupons? No problem. Now you just have to deal with 1 cash flow, and that's your principal payment at the end of year 2. Now that you see the factors behind bonds and the fact that you have to be patient to earn stable rewards, you can get an idea of why people tend to neglect them. It might surprise you to hear that the bond market is far larger and far more active than the stock market, but that's a fact. When it comes to investing, bonds are often overlooked in favor of stocks. This is because bonds tend to be seen as less risky and therefore less profitable. The relatively low level of attention paid to the bond market has contributed to the public's misconceptions about it, and it is one reason why the public knows so little about the bond market. It also doesn't help that most people who buy bonds buy them intending to hold on to them for a while, and many people are leery about investing in bonds that seem too complex. Another reason bonds are often overlooked is that they tend to provide steadier, more predictable returns than stocks. This can be seen as a downside by some investors who prefer the higher potential rewards of stock investing. Bonds are also less simple in the sense that you have to be aware of the different factors that affect their price and that they have an expiration date. So, most people would rather just place their money on a familiar stock, mutual fund, or ETF and watch it grow. At the most, they have to be mindful of a potential dividend from time to time. Finally, you also have the emotional roller coaster that comes from trading financial assets that are hot or trendy. I mean, what do you think is more appealing for most people? Pretending to be Elon Musk by trading your single Tesla share and still fail miserably, or, quote-unquote, showing off your 5-year treasury note at your next Christmas party. And if we add up crypto and the whole "to the moon" mindset, the steady but humble approach becomes a financial baby thrown out with the bath water. I get it, bonds can be more complex than stocks, and so many starting investors simply don't bother to learn about them. But if you don't take the time to understand how bonds work and trade, you could be missing out on a great opportunity for profits in the long run. Bonds may not be the sexiest investment in today's economy, but they still offer many attractive features. For starters, the advantage a bond possesses over a share is that the investor is promised a return, which makes it ideal for investors who are risk-averse or nearing retirement. Additionally, bonds can provide a steady stream of income, which is especially appealing during wild economic downturns. Another benefit of investing in bonds is that they can help diversify your portfolio. By including bonds in your portfolio, you can offset some of the risk associated with stocks and other traditional financial assets. This is because during normal times, bonds and stocks tend to move in opposite directions, so when stock prices are falling, bond prices may rise. Even though bonds and stocks are generally traded on financial markets, bond investors are less exposed to a total loss of their money in comparison to stock investors. That is, because debt is backed by a series of legal rights. In particular, the legal right to collect annual interest before the equity shareholders receive a dividend. Thus, in a bad year, bond investors have a greater likelihood of receiving payment. They can even be the assets of an entire firm when it defaults on its obligations. In the worst-case scenario, it is more likely to save someone's investment if they are holding onto debt-type financial securities rather than equity. When an entity goes bankrupt, on liquidation, the holders of debt-type financial securities are paid from the proceeds raised by selling off the assets before shareholders receive anything. And finally, unlike some other investments, such as collectibles or real estate, bonds are relatively easy to buy and sell since they have a very liquid and extensive market. While bonds are often thought as a very safe investment, there are several risks associated with them. Interest rates are in constant change, and as we have seen, bond prices have an inverse relationship with interest rates. That is, if rates rise, the price of bonds will fall. This means that investors could lose money if they need to sell their bonds before maturity. Moreover, new bonds are issued at a higher rate, making existing bonds less attractive to investors. Another risk is credit risk, which is a probability that the issuer of the bond will not be able to make interest payments or even repay the principal when it comes due. This can happen especially if the bond's issuer's financial situation deteriorates. To mitigate this risk, you should aim at bonds from high-quality issuers with strong credit ratings. Another important factor that is often overlooked is inflation. Over time, inflation will reduce the purchasing power of your fixed income from bonds and decimate any progress that you've made in your portfolio. One way to neutralize this risk factor is to engage in strategies that benefit from an acceleration of inflation. For example, inflation-adjusted bonds or even floating bonds. Floating rate securities in particular can provide a fairly good hedge against inflation risks, considering that the returns are likely to remain consistent or rise in response to changes in inflation. Investors should be aware of these risks before investing in bonds. They should also consider their own investment goals and objectives before deciding whether or not to invest in this asset class. Moving on to more indirect risks, when you invest in bonds, you cannot influence how the company operates. In other words, bond investors are more quote-unquote passive investors. They usually receive a fixed rate of interest and can only receive a substantial profit if their bonds become highly demanded on the bond market. In similar fashion, bondholders do not typically share in the increase in the value of an extremely successful business, and there is a lack of any voting power over its management. As with any investment, you should ask yourself if a new asset class aligns with your financial needs, and if it will contribute to your overall portfolio. And better yet, that this asset class can create synergy with others. When it comes to bonds, there are lots of questions that would be impossible to cover in a single video. Or they worth your time and money? Well, the answer may depend on your circumstances, but there are some things to consider before making a decision. Bonds are often overlooked as an investment option, but they can be a wise choice for investors who are looking for stability and income. They tend to be less volatile than stocks, so you won't see the same highs and lows. That can be good if you're risk averse or close to retirement. So, don't expect bonds to make you rich quickly. Always keep in mind that their returns are usually modest. Bonds can provide a steadier stream of income than bonds, and they can offer protection against inflation given the appropriate bond. And as we have seen, bonds are not without risk. Interest rates can rise, which would decrease the value of bonds, and if you need to sell your bonds before they mature, you may not get back the full amount you paid for them. Inflation can be a true nightmare for several bonds because it erodes the value of a bond's cash flows. And default risk can be the ultimate deal breaker when there's a high chance of not getting timely interest and principal payments. Or even worse, when you end up empty-handed. As a final note, it should go without saying that if you're thinking about investing in bonds, it's important to stay up to date on economic trends. We've reached the end of this video, and I can already expect you to have more questions than answers. My main purpose was to familiarize you with the basics of this topic and open a discussion for more to come. In the meanwhile, let me know in the comments if you have already made investments in bonds. How was your experience? And if you haven't, what has held you back? This is Eric from Markets, and I hope to see you, dear viewer, in the next video.